You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Welcome back to this week's edition of the Systematic Investor Series with Jerry Parker and I, Niels Kostrup-Larsen, where we each week take the pulse of the global market through the lens of a rules-based investor. For long-time listeners, our conversations are intended to keep you focused and inspired to continue your trend-following journey. And if you're new to the show, our hope is that today's episode will trigger your curiosity to check out the back catalog and all the past episodes that you may have missed. Morris is out this week, down under, not with the flu, but in Australia, so he'll be back with us hopefully next week. Jared, just you and me, how are you doing?
Doing well. I'm in New York today. It's a little cold, not used to this cold weather being from Florida, but good to be with you and see you.
Yeah, absolutely, likewise. I was out for the week skiing, so didn't pay that much attention to the markets. But of course, we can't not notice that U.S. equities hit another all-time high this week. I was just going to say, as did the dollar, but not quite. But it's certainly flirting with recent highs, the dollar index, that is, which created a little bit of headwind, potentially, I guess, for U.S. commodity exports, particularly in the agriculture sector. We didn't see massive reaction so far, but we did see things like coffee had a pretty decent reversal to its downtrend with a big up move this week. As mentioned, the equities went up early in the week and then softened off Thursday, Friday, but actually gold was pretty good at keeping it close to its recent highs as I guess as a safe haven asset. So on our side, I would say that it was a positive week for sure, solid week, mainly driven by the equities, as it has been for a while. But the currencies with the stronger dollar was a nice contribution as well. Fixed income, metals, meats, energy were pretty mixed, and I would say overall flat from what I'm seeing. And then we had the grains and the softs, where we saw a little bit of a pullback in performance this week. So that's kind of what I managed to observe from the slope, so to speak. What about you, Jerry? What did you notice this week?
Yeah, pretty quiet week. The grains, the wheat doesn't know which way it wants to go. So I think I'm long one and short another in that sector. Just one comment. I don't really like, I know the rest of the world likes to talk about the dollar. I don't really talk about the dollar because it sort of belies the fact that you and I trade lots of different currencies, and they're, versus the dollar, just like all our commodities are versus the dollar. So, I've got some long positions in some of the currencies, some short positions. The euro and that concoction of an index called the dollar is heavily weighted. So whatever the euro does is probably going to, dominate the dollar index. But I'm still long some shekel. I saw that in the news this week. That's by far the strongest currency. And there's Russian rubles up there. Maybe India is strong, and then most of Europe is weak, along with Aussie, Canada, and New Zealand. But Mexico is pretty strong, the peso, and lots of fun things going on in the currencies. And so I have a tendency to look at them like I do the stocks, and because I can afford myself with lots of diversification with the single stocks, I'm long some, short some. So I'm never, during a really solid week in the stock market, I'm always lagging behind because I'm too diversified. I don't have Microsoft, Apple, and Amazon, for instance.
Yeah, no, I mean, I think that's a great point, actually, because this is exactly the same on our side. Although we only trade the major currencies and all against the dollar, you're absolutely right. The positions are mixed. And so when I said the dollar, you're right. The dollar index is really the one that is so heavily weighted towards the euro. So I guess it's the euro that's having a bit of a weak period, maybe more so than the dollar being super strong. Cool. I guess we had lots of reactions to last week's conversation. It was fun. It was good. It was passionate. And of course, Tesla contributed maybe also to a lot of the debate to that. So that was great. We appreciate all the comments and feedback we got. So keep that coming. Why don't we talk about some of the topics that you came across during the week in your Twitter feed, and see if there's some articles we can dive into. We have a few questions as well, of course, and as always, you can send them to us at info@toptradersunplugged.com, and we'll do our best to get them on the first show available. But let's jump into some of the topics. I know there's a few good ones that we might be able to spend some time on.
Yeah, last week was fun. I don't anticipate getting into quite a big discussion this week. I think Moritz is the one who gets us going. He pushes us, and without Moritz, I think it's going to be more gentlemanly today. Anyways, I read another good article yesterday from Morgan Housel, and it's called "History is Only Interesting Because Nothing is Inevitable." And he says nothing that's happened had to happen or must happen again. Specific events are always low probability. Their surprise is what causes them to leave a mark. They were surprising because they weren't inevitable. And I think, this is kind of why trend following works, is because we're always getting in these trades that are surprising to everyone. How can Tesla rally so much? No one saw this coming. This is not part of history, and you can't predict these things. And so even though we look at a back test and we look at results and with a systematic rules-based approach, we're not predicting that the markets are going to have these same moves and the fundamentals are going to be the same in the future. It's going to be much different. And we just, that's why we're making money all the time from things that have never occurred before.
I think that's a great point. I mean, it's like when you hear people talk about how many of these past crises that the central banks have, seen ahead of time, and the answer is none. And I think that's really something that we have to kind of accept, that we just don't have that ability. And what happens, of course, after the crisis, people will say, "Oh yeah, sure. I mean, you could see it coming." Interestingly enough, I think there's a lot of people right now who are seeing the next crisis coming, right? I mean, if you look at some of the massive debt issuance, if you look at, and I'm not an expert here, but if you look at certain valuations, if you look at the fact that you have negative yielding junk bonds, and you have, 13, 14, 15 trillions of bonds in general having negative returns, I'm sure once, when the next crisis start and play out, some people were saying, yeah, sure, but you could see it coming. Look at all these factors. But I wonder how many investors really actually use this period where something is brewing, whatever it might be. As you say, it's not going to be the same as last time. It'll be something new, something we probably haven't even thought about right now. But I just wonder how many investors, are using this time preparing themselves for this. Because the more I hear, the more I see, when you see these flows, people just keep putting money into strategies, as far as I can tell, that are not very liquid, where you end up locking up your money for a long time. You pay, fixed fees without necessarily getting any return or linked to their return, etc., etc. And I'm puzzled by why it is that we are setting our things, or I think people are setting themselves up to be disappointed when the next, whatever it's going to be, crisis comes.
Yeah, the article is really, he goes on, it's really long, and it's really a good article. He talks about how no one could predict. There was a lot of smart people trading and investing. No one could predict the depression and the stock market crash in the 20s. And so how fruitless it is to think that they were dumb or that we're smarter, but you just can't predict these things. There's a friend of mine on Twitter. He tweeted this week, "I'm trying to fit some hypothesis to empirical fact that the financial media is net bearish, yet stocks rise. And he goes on to say, like, don't these people kind of realize that if the reason the stocks keep going up is because they're so negative on stocks. So stop being so negative and you'll get your wish. And I think Twitter and social media, a lot of it is just like a thermometer. It's not causing stocks to go up, but it's measuring the temperature of people. And the more you just have to give in and give up, and maybe they're trying to pretend like they're so even-handed. I'm just following the facts. I'm just evidence-based, and stocks are going to crash. Well, they've been saying this for so long, and they won't go down. So just like relax, leave it alone, and you can't predict. If you're not going to follow the trend, at least quit embarrassing yourself with all this negativity, because you're sort of feeding this rally. And anyways, I'm sure it's frustrating when you don't look at things in terms of trend. Sometimes just taking small losses, as frustrating as it can be, is the least of your problems if you miss out on a big trend.
I think that the way what you were saying about the media, I think the media is plays a very interesting role in general. I was listening on my way back from this ski trip. I was listening to the latest episode on Macro Voices, where Eric has Chris Cole actually on the podcast, and I suggest anyone should listen to it. Chris just produced one of his big write-ups, which I think is very thought-provoking, and people should also get a copy of that. But there was another guest that came on later in the episode that I was listening to. And I apologize, but I forget his name, and I only kind of remember some of the things he said. But triggered by what you said about the media, he was talking about certain statistics that when you look at them right now, they definitely resemble some kind of depression, right? They're similar to what we saw in the two previous depressions in the last 100 years. But the question he raises, which I think is an interesting one, if the media doesn't talk about it, does that mean it doesn't count? Because he was then referring to some unemployment numbers, some recent unemployment numbers, where he was saying that the media had described the November number, I think, was, like a slam dunk. This was just an incredible number, right? And there was a January unemployment number was something, where you saw a surge in jobs being created. But when you look at a chart, it doesn't suggest anything like it. It's just pretty ordinary numbers. But because the media talks about it in a certain way, it kind of becomes, oh yeah, that's the way it is. But then again, on the flip side, if you don't talk about things in the media, does that mean it doesn't exist? It's not there anymore? And so the role of the media is really interesting. And I think you're right about the fact that there are so many people saying that stocks, we're going to have the next crisis next week and it's all doom and gloom. Yet the market just ticks along very smoothly.
Yeah, it's really interesting how that happens. The media and the logic, paying attention to prices, and someone said this week that the prices is the only indicator that doesn't deviate from itself, and it's just really humbling to sort of make yourself follow prices above all else. It's really just unethical to AI and machine learning, and it's got to be something better than just us doing this silly thing of following prices.
It's funny, even some of the people we've had on the show, and I have a lot of respect for them, but some of them really, I would say, have been bearish on these markets for quite a while, and they've been very vocal about it. So there's no secrets there. And I'm just thinking, these people are super smart, very gifted, but instead of having these views where they always want to try and pick a top and come out with all these evidence of now it's turning and all that, as you rightly say, why not just look at the price? And if when the market has traded off for 5-7%, which would be more than it's been doing for a long time, maybe with the Q4 of 18 as an exemption, then you go short. Why try always to try and pick the top while the market is going in this relentless bull market, which for all we know could continue for another year? Who knows?
Yeah, because, history, we're looking at history. This is evidence, but it's not evidence. History is the past with different facts and different situations, and history is not a good guide for the future. Well, wait a second. You're trend following. You did this back test of history. You want to use all the data, regardless of how far back. Aren't you paying attention to history? Not in the same way. We're not paying attention to the history, the fundamentals that drove the markets. We're just using a systematic rules-based approach, using price only, buy here, sell there, moving averages, breakouts, strength, relative strength. And so we're looking silly sometimes because the valuations are out of control. We've never seen interest rates this low. Certainly they've never been this low, so now's a good time to sell? No, the trend is higher. And so we're sort of using history, but not in the kind of in the way that most people want to use history. History is not a good guide to the future. The future is full of surprises, things that have never happened before. Longs and shorts and the CTAs are profiting. How did you know this was going to occur? Well, we didn't. But these trends all start with a breakout and we lose on 60% of the trades. So it's not like we're good at predicting anyways.
And maybe that's part of the problem, in a sense that what we're saying to people is that we use historical data to, our strategy is based on historical data. And I think maybe people think that, oh yeah, if we've seen it in history, it must repeat itself and therefore you're going to do well. But the reality is that the secret to trend following, so to speak, is the fact that it's adaptive. It just uses history as part of the input. But the truth is that our systems will react to whatever happens in the future, the way it happens in the future, not the way it might have happened in the past. And so, yeah, maybe we're doing ourselves a little bit, or maybe it's confusing for people to think about us looking at historical data in order to make money in the future, when we all also say that, and rightly so, the future is not going to look like the past.
The breakouts might, and what the systems that worked in the past might, but it's kind of crazy because, like, we're designing these systems and we're saying, look, use all the data. Okay, I can see that. Now, trade all the markets the same. Really? Yeah, in the longs and the shorts. So we'll have a system that got us into, let's say, Tesla, which is a great trend-following trade. It's an outlier so far, and it's gone up a lot, and it's bought the breakout, and we're holding on to this open trade, and the trend is still higher. But the system that we use on Tesla, Tesla wasn't even around over the test period. And it may be dominated by what worked in the currencies or the commodities, And so some of these approaches and parameters that we use, they're being influenced by the longs and the shorts and markets that are not Tesla. So I'm trading Tesla based upon what worked the best over all the markets and throw the shorts in as well. And people are like, well, that can't be right. It's not fine-tuned to Tesla. Tesla has its own personality and its own history. No, it doesn't. I mean, yes, it does, but that's not a good guide to when should I buy, when should I sell, how should I approach these crazy trends that I've never seen before. So you're using methods that are based upon history and mixing them all together, the longs and the shorts and all the different markets, and trying to apply it to a brand new, relatively speaking, company. Yeah, exactly. And it works. Well, I mean, it's the best thing to do for the future.
And I think it goes back to some of the things we've talked about in the past, and I know a lot of people have spoken about, and this is these human biases. And of course, we say a lot of trend following can be linked back to behavioral finance and all of that stuff. But one of the biases we have as humans is this precision bias. So if you ask someone, so what do you think S&P is going to finish at the end of the year? They're going to be incredibly precise. 3,875 and a half. That's going to be their prediction, instead of just saying, oh, somewhere between 3,500 and 4,000. It's not precise enough. So I think you're right. I think people deep down want to believe that if you want to trade Tesla, you have to develop something specifically, so precisely tuned to how Tesla trades. And yet we're saying, no, it doesn't matter. and
one of my favorites
it's hard.
is, I hear this a lot. Stocks are different. Stocks are different. Shorts are different. Oh yeah, shorts have different blah blah blah. In stocks, oh my gosh, there's specialist or there's flow or there's these terms. I'm like, really? Because I'm just looking at those trends. Some of the best trends I've seen over the past 10 years, 20 years are in stocks. So somehow the best market out there are these stocks, FANG stocks that have gone crazy and made so much money. And the trends have been fairly smooth and bigger trends than we've seen in our markets because we're underperforming. And yet maybe trend following doesn't work on stocks. It's only worked on stocks really for the past 10 years to a large degree, and the bond market as well. So there's always a reason out there where not this time is different necessarily, but this market is different. You can't expect this with the shorts or the longs or the stocks. And it's just like, okay, watch me. I'm not going to change. I'm going to follow these trends. And, usually it works out pretty well. It's certainly the best method I've found, if you just adopt this whole idea that you can't predict. No one knows where the markets are going.
Yeah. Speaking of another thing that I was triggered to think about from the interview I listened to with Chris Cole and Eric Townsend, when you talked about stock has been the only thing, maybe with bonds as well, of course, that has worked the last 10 years. And I don't know how he did it and how he measured it, but he does go on record saying that, so they've gone back, I think, 100 years to do some big analysis, creating kind of the perfect portfolio, to use a term we've used before, but 100-year portfolio. But one of the things he said that in their research, they found that the last 10 years has been the most mean reverting decade or period throughout the whole set of data. And the most difficult one for something like we do, trend following. So if you've been able to make some money in the last 10 years as a trend follower, given the conditions that we've seen on a diversified portfolio, not just trading stocks and bonds, you would have done well. So that was just another thought that came to mind when you talked about these things.
And as good trend followers, though, you shouldn't. You should only look at how your system or how your performance has been on all the markets and longs and shorts and the stocks or commodities, currencies, and bonds. And don't slice them up into longs versus shorts or stocks versus everything else. So it's perfectly fine to and preferable to throw them all in and say, this is how we performed. We require, trend following definitely requires as many markets as possible. It's going to be much better the more markets you trade than fewer, because of the low win rate and the reliance upon outlier trades. And so it's only right that we quote our performance and look at it in terms of all the markets and not try to slice it into different sectors or markets. So that's It's very tempting.
Yeah. Well, that was Morgan Housel kind of tempting us into a deeper dive. What else did you see this week?
So I like this interview that Meb Faber did with Tim Hayes from Ned Davis. I have some experience with Ned Davis, following them over the years, and it's a firm that is into market research, all the markets, but especially stocks, and a fair amount of technical research, numbers-based, trying to quantify the market in lots of different ways, not just trend and price, but they do include some trend and price. So I was particularly looking forward to this interview, and he talks about some of their indicators, that 50% of the indicator is price-based and 50% is sort of quantifiable fundamentals, let's say, based. And he talks about the indicator and says 20 times in 30 years, this indicator has gotten to a danger level and the market has continued higher. If you relied on non-price indicators in 2007 and 9, you could have very well have gotten caught on the wrong side of the moves. And he says, remain trend sensitive and be careful about emphasizing any one indicator, because something can enter the picture. But if it's going to be an indicator, it should be it should definitely be a price-based indicator because price is what it is. Price is unique in that it's the only indicator that can't diverge from itself. So building on Morgan Housel, once again, these indicators can be dangerous because they're indicating that now's the time to turn the light switch on or off. It's not really as much probability as we're being told now that it's time to reverse our position because these indicators are present when bad things happen or good things happen. And so it's much different than the way we approach the markets. And once again, he's just reemphasizing it based upon their research that, the indicator can be way early and the market has more room to run. And so mixing in some humility and some of your trading with price trend is going to keep you on the right side of these moves when, according to these fundamental or value indicators, it may be irrational. But people can be irrational and the trend can keep going and it's decent money. Why not make your money when people are irrational as well? And maybe the final analysis, CTAs only in trend only works. We've made all of our money illegitimately because the markets were not rational. Okay, whatever. I'll take that money as well.
Sure. No, I mean, when you talk about indicators and indicators that can suggest things that are about to run into difficulties, yet it continues. The first one I that springs to mind is relative strength index. I mean, how many times have you seen the relative strength index hovering around 80 or 90, thinking, oh, it just certainly can't go any higher, and just continues to go up, and suddenly you have something called divergence, where the market continues up and the strength goes down, and you're kind of completely screwed if you try to use that. So you're right. I mean, again, the point is, and in my opinion, that if you think a market is going to go down 50%. Well, it's going to go down 5% before it gets to 50. So why not just wait for it to go down 5 first, and then you can jump on the bandwagon? I mean, it's not that complicated, so to speak. So yeah. Unfortunately, I haven't listened to that episode with Meb, but it sounds like it's worthwhile to do for sure.
Yeah, over the years, I've followed Ned Davis. I visited them. I've heard Ned Davis speak in person, and I got a little intrigued with maybe trying to find ways to improve trend following, add in a few other things. And I know once I heard him speak in New York City at luncheon once, and he gave a long talk, and they have lots of numbers and indicators, and they just can look at so many different ways of to measure what the market is doing and the underlying health of the market. That's another cliche. And then I remember him giving this talk for 30 or 40 minutes, and he sat down almost right in front of me at this lunch table and said, yeah, that stuff's good, but sentiment and trend, that's all I look at. I mean, that's the most important stuff. So I'm like, okay, fantastic. So I'm glad I was here, but, it's seldom do you hear anyone able to stand up and make a credible case, or even desire to make a credible case that your trend is really not your friend, when in fact that's what everybody sort of sees. You can, and I've said before, with artificial intelligence or machine learning, I'm sure at the end of the day, if you just put in a little bit of trend, it's going to make all of those systems as well kind of perform a little bit better. But so to finish up with this, where we are today, there was one more tweet from our friend Jesse Felder, who we've had on the podcast before, about indicators, and it's evidently there's something called Hindenburg omens, and I'm not sure what it is, but you can check it out. And the title of this was, "A New Cluster of Hindenburg Omens Betrays the Bullish Case for Stocks." While an individual signal has very little value in forecasting a stock market crash, as some seem to suggest, a cluster of signals can be valuable. And for most trend followers, we're not keen on one indicator or a bunch of them. And then I write, would a clustered omens backtest yield rules that outperform trend following, a moving average crossover? Omens have appeared just before corrections, but what are the costs when they've been false indicators? they keep you out of big trends. So let's just add them up. Do they have any predictive value? What is the historical significance and value of these omens when you put them into a systematic approach? The probability only tells a partial story because if they predict 60% of market turnarounds, what about the other 40%? What if you miss those and you have these crazy outlier moves? So yes, the omens maybe they're good at predicting, but when they're wrong, they fail so miserably and so spectacularly that you end up making a lot less money. You can be very bold with the trailing stops and stop losses. And, oops, I was wrong, but I made more money than you. So I think rather than continuing to write articles about, for me to read these articles, I'd like to see people kind of back testing these indicators and seeing if it beats moving average crossover.
Yeah, I'm sure we would love to see some evidence of that. But of course, it goes back to this thing about it's a great story, right? And again, I'm not suggesting necessarily that the media has. They love these stories as well, but I'm not blaming the medium then, because usually these come from analysts and other people when they come out with these statistics. So I think we're back to this point about if you make something sound, intriguing, or if you make something sound complicated, I think people gravitate towards that. The fact we've been saying for the past 40, 50 years that what we do it's not magic. I think what we've forgotten to emphasize in saying that trend following is not magic is that what trend following does to a portfolio is magical, because I think that's really what it is. But because we keep saying that what we do is relatively simple, it's just not that interesting. And the only thing that we get from it is that people say, okay, but if it's that simple, we shouldn't pay for it. So let's just pay 50 basis points and that's it. So we've kind of been hit by a boomerang, I think, in trying to be very truthful and honest about what we do. Maybe we need to think about a different approach to selling ourselves.
Yeah, I mean, I know when I first got interested in investing, I was in my early 20s, and I would watch these TV shows, and the two things I remember was I was intrigued by gurus. These are people who are telling me what's going to happen in the future, and this is really exciting. They kind of know, and I'm like, whoa, this is really cool. I need to follow these people, and it's much more sexy and interesting if you can buy into the idea of following really smart people who can predict the future. And then number two was they're very negative. And so, being very negative, that attracts people as well. Not a positive story, not optimism, but being able to predict and being able to call crisis and doom and gloom. It really does end up on the front page more so than good news. And people who are boringly saying, look, just follow the trends. I mean, well, anybody can do that. I can do that. Why should I even pay you or listen to you? But whether it's the most profitable and safest way to manage your assets and attack the markets is sort of irrespective of how interesting it might be.
Yeah. No, I mean, we can just look at the newspapers in general. I mean, very few positive stories makes the front page. It's always something about fear. That's how we see most people being sold and promoted, certainly also in the financial news media. That's just the way it is. Nothing we can do about that. So those were the tweets, essentially, if I understood you correct. That was the last topic you wanted to bring up now. Okay, fine. We've got a few things we can talk about. We've got a couple of questions, and we've got some other topics that we have discussed in the past. First question is in from Michael. Michael says he has 2 questions this week. But let me read the whole message here. But I would first like to say thank you for a very good show last week. Episode 74 could be part of the Systematic Investor Greatest Hits series. I'll be listening to that many more times. Anyways, here are the questions. Would one or all of the hosts releasing a real trend-following ETF create too many potential problems for their day job. I'm not entirely sure what that question is for, Michael. And maybe actually I did ask you during the week what it was, and maybe you said, well, let's just skip that one. So I've completely forgotten about that. So let's skip to the next question. Could a trend following system be improved by eliminating the SPX stocks? Given how challenging it is to follow a trend following system, with the SPX being a long only trend following system, I wonder if the performance of a trend following system would be better if it was restricted to stocks outside of the index.
Depends upon the diversification you get, and are those, and then I think not trading an index is better. Just trade the individual markets in the index. You'll be long some, short some, flat some. So it's a combination of indexes are limiting your diversification and your outlier trades. And I don't think that adding a bunch of markets together into an index is as legitimate a systematic approach as trading all the components of that index with your system. And you're just missing and blowing the opportunity for more diversification from a systematic point of view, and then I can come up with a much better diversified group of stocks than any index, which is probably going to be cap weighted. So there's no reason to trade these indexes. I've said that a million times.
Yeah, no, I know you have. And actually, it's an interesting thing, right? Because we often say to people, certainly to investors, you should never trend follow a trend follower, right? You shouldn't buy the highs and sell the lows. You should just own it. And so it's kind of an interesting thing, I think, the question about, should you not trend follow or not use an index as the SPX as in your portfolio, because essentially it is a long only trend following system to some extent. So I can see where you're coming from, Michael, but I think as Jerry said, I mean, he also believes that, getting individual stocks into your portfolio gives you more diversification for sure. So thanks for this. Next question is from Chris. He also says the past episode was one of my favorites, not just because of differing of opinions, but because it had me thinking, which is always good. So thanks for that, Chris. So I think in now that I see the question, I think Chris is taking over Morris's role maybe to get us going today, Jerry. He says, please forgive me in my ignorance in terms of vol targeting. I'm not in the field, and it is not a term that I'm familiar with. I'll be reading more about it though. So I think maybe Chris wants us to talk a little bit about how we understand vol targeting, but he does go on and say, in the episode, Moritz had an explanation of vol targeting, and it hit home because it is how I size positions. I use ATR to help determine my sizing. If in a position and the ATR changes dramatically, I adjust my sizing. But if I understand Moritz, this is exactly what vol targeting is. Am I understanding that correctly? So what, because you and I might even also have different opinions about what vol targeting is, but how would you address Chris's query about this?
First of all, I'd say that Moritz does not provoke me. It was a total joke at the very beginning. I don't need anybody to get me going. Another human being. I mean, these topics can get me going. It's something like vol targeting. But yeah, I think it's proper to, when you do a trade, to risk the same amount on every trade and size your positions based upon the volatility, so you can do that. And I do that with all my trades and always have. And then as you get into this trade, like Tesla, for instance, it's a great example of the volatility kind of goes crazy. It really jumps. The initial vol is so much lower than the current volatility. And so do you sort of hang on to that open profit and let it dominate your performance and make you these big, huge swings? Or do you, prior to the trend reversal, or maybe at the all-time highs, the volatility is gigantic, 10 times what it was when you put it on, but it's at the all-time high, you say, okay, I'm going to cut back some because I don't enjoy, number one, these portfolio swings coming from one market. And so I think that when you have a big trend and a big profit like Tesla, and reducing that sum, quote unquote sum, probably is not going to hurt your profitability dramatically. And of course, for the Tesla trade, it might actually help it. Who knows? It's a guess. It's just not based upon your system. But I think what I don't do is I don't do this daily. Every single day I increase or decrease my positions based upon this change in the ATR or the volatility. So it's a long, drawn-out topic, and so I think part of it is something you shouldn't do if you're trend following, because you're happy that this trade is more volatile, more profitable, crazy, making all this money. It's an outlier trade. It's dominated your past performance. It's a reason we make money. So you don't want to screw that around and take small profits. But then on the other hand, you may want to reduce it somewhat. And in my opinion, somewhat of a discretionary move.
Yeah, so I think vol targeting has with different people probably different meaning. The way I understand and the way I think about vol targeting was that some years ago, I would say that some managers that I saw their material from would start talking about how they would vol adjust their positions every day to have the portfolio at a specific volatility level at all times as best as they can. To me, that's vol targeting, because you're trying to stay at, say, 15% vol or 10% vol at all times. Now, there is, in my opinion, also something different, but also has to do with adjusting positions. And certainly on our side, for what we do within our strategy, we don't vol adjust because we don't have a fixed target of volatility, but we do have a risk budget. And the risk budget can change. So we're not targeting a certain specific risk budget, but on a daily basis, we have to adhere to whatever the budget is. And therefore, we may, on a daily basis, not necessarily every single position, but there are certain positions that needs to be adjusted accordingly. They could also be adjusted because the signal is getting stronger or weaker. So we don't really care about the volatility. The volatility can be 20%, it can be 30%. That doesn't matter. But we certainly have some risk parameters we need to stay within for, on a daily basis, based on how we, in our case, how we interpret the opportunity set and the trending environment. Because to some extent, you want to allocate the right amount of risk at the right time. You don't want to be at full speed during a period of where there's absolutely no trends. Vice versa, you want to have full speed during periods where there are lots of trends. And there are different ways of doing that, of course. But so I think these things often get mixed up. And then as you say, Jerry, then there are obviously other ways you can do that. You can just look at specific outliers and say, it makes sense to take some off the table, because clearly the ATR has expanded dramatically from where it was. So it's playing too much of a dominant role in the portfolio, and I don't see that there's any issue with that at all. So I think it's a relevant question, Chris. I think there are a few different answers to it, but hopefully this gave you a little bit of color. We'll see what maybe Moritz has another explanation when he comes back that he can add to this discussion. It certainly won't be the last time you hear the word vol targeting on this podcast, that's for sure. Our friend Adrian, who was at the live event in New York, has a question. It's a kind of a different question. I think I had to kind of read it twice before I kind of got it, Jerry. So, but I think what Adrian is trying to get at is that when running a business, like we are involved in businesses that specifically, into our industry, there are certain things you have to say no to. It's just certain things where we say, no, I'm not going to do that. So he's asking, what are the two things you said no to in the last couple of years relating to systematic trading? So I guess he's asking, what are certain cardinal things that we just don't want to entertain, so to speak, in either our business or in our trading? Can you think of? I'll throw out one to begin with if you want a little bit more time to think about it. This is more of a business issue, and of course, I can't really speak for our owner, but I know this to be true, so I think I could talk about it. And that is, a lot of people come to us and ask if we won't do a flat fee product, and the answer so far has always been no. We of course have a history of charging 0% management fee. In 45 years, we've never charged a management fee. We only make money when our clients make money. So it's a deep, grinded DNA, or into our DNA, that we always want to be on the same side of the table as the investor. And we want to participate in their success, and they shouldn't pay us if we're not delivering returns. So this flat fee issue is something that has become incredibly popular. Many managers who, by the way, most of them, a lot of them saying that, oh, what you do is so easy, we can do it for 25 basis points, So that's obviously fueled the discussion and the appetite for flat fee products. But that's one thing that I say to you, Adrian, that's one thing that every time it comes up, so far the answer has always been no.
Well, I've mentioned on the podcast many times, the 10 commandments of trend following. So there's probably 20 or whatever, but I think the most important thing is to just never trade the markets different, trade the shorts, the longs and shorts the same, trade all the markets the same. I would never be tempted not to do that. I read about it, and that's how I get tempted, because it seems like other people are having success not treating all the trades the same. So I think that's a big part of it. So I think, I lost my train of thought, but that's a key. And then I think, here's what I was going to say. And that is, so kind of contrary to what you were saying earlier, is take all the trades. I think that's like one thing that, and I think that looking at vol targeting and risk budgeting and things like this, whatever stands in my way to take all of the trades in the same exact way, I will, not pay attention to risk budgeting or vol targeting or anything like that. I want to set up my portfolio. If down the road I'm perceiving that, you could have on a lot of trades and a lot of open profit and not, and your risk budget would prevent you from taking the next British pound buy, then I'm going to trade smaller. I'm going to figure out a way. I've got to do that British pound trade every single time in the exact same way. I can't have any sort of money management overlay or risk budgeting that would prevent me from doing that next trade in the exact same way that I've done it over all the years. And so if I'm going to run into those situations, then I'm just going to trade smaller and maybe leave money on the table, because every rare event down the road somewhere, I might not be able to afford to do the next trade. Well, then I'm going to trade smaller so I can do every single trade. I think that is the one thing that is most important to me, is that I'm in this transactional business of every time the market does this, I buy. Every time it does that, I exit. I've got to make my risk management subservient to that. The system, the buys and the sell, is not subservient to money management. I'm going to do all of those trades the same way every single time. Buy, sell, entry, exit. Yeah. See how I got really passionate about that. So I didn't need Moritz here to get me going.
No, it's great that we've now found another one who can help us with that. What about, let's stay on this topic a little bit. What about from a business point of view, Jerry? are there certain things from a business point of view, you've been doing this for a long time, are there certain things where you just say, yeah, no, I'm just not gonna go in that direction, whatever that might be? I don't have any suggestions, but I think we have to sometimes separate Jerry the businessman and Jerry the trader, right? And I think very few people have actually succeeded in doing both. Often you see a great trader bringing in someone who's great at running a business, and that's how they end up with a great result. You've kind of been doing both. for a long time. So, I mean, are there anything from a business point of view that you would say is something where it's a very easy no for you?
Well, I mean, I don't think it's easy. I think there are many situations where you would enhance your business, let's say, for in at the expense of what I would consider to be proper trading. So I do think that you and I we discussed this idea of clients, and I think that clients do prefer vol targeting. They prefer, like, hey, we can give you a constant 15% volatility. Thank you. Yes, we love that. Well, I think not doing that is not, it's client friendly as much as doing it is, but I don't think it's right. So I think you're always faced with these issues. If we traded indexes versus single stocks, clients really don't want single stocks from CTAs. And I agree with that, but it's better to trade single stocks. So I have not had a business that is as big as it could have been because I'm hard-headed and I defaulted to, well, this is one of my 10 commandments of trading. Well, you really have a small business. Yeah, kind of. And so I think that figuring out how to meet the clients halfway and modify. But I do think that some people actually do believe this. They actually believe, no, vol targeting is wonderful. You're wrong. Okay, cool. I don't think trading indices is a problem. Okay, cool. So I wouldn't rule out the possibility that I'm wrong or that other people actually do believe that they're not violating their ideas of proper trading. So I think that those are just two. I can't think of any others right now, but I'm sure there's many more opportunities to where, and then of course, if you are really successful and really good at what you do, and then you can sort of get your way. And if I was a better trend follower and making money more frequently, and I told clients I'm going to trade these single stocks and I'm going to I'm not going to vol target, then they would say, we don't care, go for it. You're amazing, you're awesome. So to the degree that I haven't always been awesome, I don't get away with doing things kind of my way as much as I would like to, as far as AUM goes.
Yeah, I mean, I think you do bring up a good point, and that is, of course, the whole thing about how we take into account the pressures, so to speak, that we have from dealing with other people's money, right? I mean, the fact that it's not our money that we manage, not all of it at least, we have to take into account how our clients feel about certain things, or how they may react to certain things, and so on and so forth. And as you have and I and Moritz have discussed on many occasions, I mean, the industry that we are in have changed over the years, and we do see some firms, I would say, rightly or wrongly, but to me it looks like they're opting for size rather than for giving people the highest possible return. So there are choices, and they're painful, and they have consequences, and it's not easy. But I also think that those who have survived for decades, such as yourself and such as Don, I think it's because we have certain things where we don't compromise, because we know that's the right thing to do. But it's a balance, and our opinions may change over the years, of course, no doubt about that. But it's, and I guess all businesses, face these dilemmas, not just our little industry. Now, last time, or maybe the last few times, we have talked about whether trend following is better, or how good is trend following on equities. And because we talk about it being better than long only, but what's the evidence? And I just want to give a shout out to Francois, who's written in before. Very kindly, just before we went on air, he sent me, or maybe I saw it just before we went on air. I actually think you sent it yesterday, Francois. He was just quoting a couple of people that have written about this. Of course, we hope to have Eric Crittenden on the show soon. He's one of the guys, but also Andreas Klino, whom we had on the show not long ago, and also Wes Gray from Alpha Architect has written about this. And And I think they have in their respective books some performance tables of strategies, kind of momentum strategies on stocks, whether they are, long, short, and the way we understand trend following, I don't know, but maybe that is a source to figure out in terms of quantifying how much better, if we believe that's to be true, trading stocks from a trend following perspective rather than a long only perspective. So I appreciate that, Francois. Thanks for sending that in. Those were the questions. Yeah.
Once again, I don't like the question, like, how does trend following do on stocks? Well, I mean, how does it do on currencies? How does it do on bonds? How does it do on the yen? So the whole point is, like, you add all these markets together, you do your back test, you have your system, and that's how trend following did. You don't separate the longs from the shorts. You don't separate the stocks. It's a market. It should trend. What market is immune or doesn't play by the take small losses and let your profits run rules? I don't think any of them do. I think they all are subject to that. So it's kind of trivial that, well, stocks have done better. They do better when I slice and dice stocks only or long only. And my response is, yeah, don't do that, because you want to trade all these markets. And why limit yourself to anything only, commodities only, bonds only, stocks only? It's all the same thing. It's all, put them all together. The perfect portfolio where you're matching return versus risk is going to include all these markets, as many as possible, shorts as well, with a trend following strategy.
Yeah, no, I mean, that, of course, that is what we truly believe in, that, getting that diversification on top of this, the trend following. So agree with that. Now, Jerry, we're about an hour into our conversation. We can bring up other topics, or we can kind of round it off gently, since Moritz is not here. Is there anything you want to, we've talked a little bit about in the past outside our normal conversations, talked a little bit about breakout versus other strategies, why, at least on my side, I prefer to breakout maybe having a more difficult time in the last 10 years or so. We can discuss that, or we can wait for Moritz to come back and join the conversation.
Oh, yeah, let's wait for Moritz. It's a big topic.
Yeah. Okay. No, that's fine. In terms of, as we normally do, we do talk a little bit about how trend following is doing for the month of February. So far, we're halfway. Beta 50 index up a couple of percent in February. The SocGen CT index up 2.69. Trend index doing well, 3.4% to the good. SocGen short-term traders index is up 43 basis points so far this month. And the bridge alternatives up 2.64. But all indices are doing well so far this year. So that's great to see. Before we finish, let me just mention that that there is a new version of my ultimate guide to the best investment books of all time that you can grab from the website if you haven't already. It's just a useful resource for you if you want some inspiration as to what to put on your bookshelf to read regarding investing, not specifically to trend following, but there certainly is a few books on trend following as well on that. But I think on that note, Jerry, let's wrap up for this week. We hope you enjoyed it. If you felt you got any value from our conversation, of course, we wouldn't mind a rating and review in iTunes. It really does help other people discover the show. But from Jerry and me, thanks so much for listening, and we look forward to being back with you in a week's time.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past. and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.